As we trade through the heart of 2026, the financial media remains predictably myopic, fixating on headline-grabbing mega-cap semiconductor announcements while entirely ignoring the silent structural plumbing holding the modern digital economy together. Let's anchor our perspective right here. Okta Inc., NASDAQ, OKTA, trades against a backdrop of deep institutional accumulation, yet retail sentiment on social platforms like X and Reddit treats the stock with cyclical fatigue. Mainstream analysts love to box Okta into an outdated legacy paradigm, viewing identity access management as a commoditized checkbox utility, comparable to an office building's front door security guard. But that superficial narrative completely misses the underlying physics of the modern cloud and enterprise software paradigm. The real structural bottleneck in today's digital architecture isn't just about compute power or optical interconnects inside AI data centers, it is about authorization entropy. As enterprises race to deploy autonomous AI agents, machine identities, and multi-cloud infrastructure, the attack surface expands exponentially. Traditional perimeter security has dissolved entirely. Every automated API call, every microservice invocation, and every synthetic user requires continuous zero-trust verification. While retail investors chase speculative momentum plays and get shaken out by short-term macroeconomic jitters, institutional heavyweights recognize a fundamental market mispricing. They understand that identity is no longer just a software feature, it is the ultimate digital perimeter and the ultimate gatekeeper of corporate data. When platforms like Okta successfully evolve from securing human employees to governing autonomous AI agents and machine-to-machine communications, the total addressable market undergoes a structural phase shift. Yet because of historical execution missteps and past integration growing pains following the Auth0 acquisition, the broader market continues to price Okta at a compressed multiple, completely discounting its transition into a mission-critical identity security fabric. Peering beneath the daily trading volumes and routine price fluctuations reveals a masterclass in institutional accumulation. Whenever macroeconomic jitters spark a broader software sector pullback or headline-driven tech sell-off, retail traders panic, capitulate, and flood social media boards with complaints about growth normalization. Meanwhile, smart money block trades steadily absorb the supply. Institutional sponsorship in Okta is undergoing a quiet structural rotation. Long-only funds and specialized cybersecurity ETFs are incrementally building positions, recognizing that enterprise net retention rates have stabilized and free cash flow generation has reached an inflection point, pushing operating margins higher. The Daily Tape tells a compelling story of institutional defense. Dips are systematically bought, and short interest, while present, finds itself boxed in by a company generating consistent profitability and strong cash conversion. Wall Street's consensus models often lag behind the velocity of enterprise platform consolidation. While analysts debate quarterly seat growth numbers, institutional allocators are looking 3 to 5 years down the line, pricing in the stickiness of Okta's Workforce Identity Cloud and Customer Identity Cloud. Before we dive deeper into the operational mechanics, let's pause right here. How are you playing this current software sector consolidation? Are you accumulating shares of mission-critical infrastructure players during these quiet pullbacks, or are you sitting on the sidelines waiting for a confirmed breakout? Drop your thoughts in the comments below, and let's dissect where your portfolio stands. To truly grasp where Okta is heading, we must strip away the legacy framing that haunts its stock ticker. Founded by Todd McKinnon and Frederick Carest back in 2009, Okta initially scaled on a deceptively simple premise: single sign-on and directory services, allowing employees to log into corporate applications smoothly. For years, Wall Street categorized Okta as a high-multiple, high-growth software-as-a-service darling, tethered to white-collar hiring cycles. When enterprise headcount expanded during the pandemic tech boom, Okta soared. When the tech sector entered a multi-year efficiency and layoff cycle, Okta's stock experienced a brutal derating. That old framework is entirely obsolete. The modern Okta is no longer just about human login credentials or basic employee lifecycle management. Through strategic evolution and major technological integrations, most notably the absorption of Auth0 for developer-centric identity, the expansion into privileged access management via acquisitors like Axiom Security, and the rollout of advanced identity security posture management, Okta has transformed into the foundational operating system for digital trust. Its business model is anchored on two massive high-margin engines, the Workforce Identity Cloud and the Customer Identity Cloud. The Workforce segment protects internal corporate infrastructure, securing employees, contractors, and specialized IT environments across complex hybrid cloud estates. The Customer segment empowers external application developers to embed secure, scalable authentication directly into consumer-facing digital products without reinventing the wheel. This dual-engine architecture creates massive switching costs. Once an enterprise binds its core authentication, authorization APIs, and zero-trust policies into Okta's ecosystem, ripping it out is virtually impossible without risking catastrophic security vulnerabilities and operational downtime. Looking toward the multi-year horizon, Okta's growth vectors are intrinsically tied to the most powerful secular trend of our decade, the enterprise AI revolution. As organizations transition from passive AI experimentation to deploying autonomous agentic AI workflows where software agents execute complex, multi-step business transactions on behalf of humans, identity security becomes the ultimate bottleneck. An AI agent requires credentials, data access permissions, and behavioral guardrails. Okta's platform innovations, including dedicated capabilities designed to secure AI agents and machine-to-machine communications, position the company as an irreplaceable technological gatekeeper in the AI era. Furthermore, capital expenditure cycles among mega-cap tech spenders and Fortune 500 enterprises continue to prioritize cybersecurity resilience above almost all other IT budget categories. Even in an environment where chief information officers scrutinize discretionary software spending, security infrastructure remains entirely non-negotiable. Data breaches carry catastrophic financial, legal, and reputational costs, making platforms like Okta an insurance policy that enterprises simply cannot cancel. However, a rigorous market analyst must always weigh the structural risks. Okta operates in an intensely competitive landscape. Tech behemoths like Microsoft loom large, bundling identity features into broader enterprise software suites, which presents a constant pricing and positioning pressure. Additionally, Okta carries the legacy weight of past security incidents, meaning execution must remain flawless. Any future security lapse or integration hiccup can trigger sharp, sentiment-driven drawdowns that punish the stock in the short term. Yet these very risks create the ultimate opportunity for the patient analytical investor. While the market stumbles over transient headlines and short-term noise, the structural reality remains clear. Identity is the permanent anchor of the digital economy. By looking past the superficial volatility and recognizing Okta's evolution into an indispensable security fabric for both human and artificial intelligence, long-term investors can align themselves with a company quietly cementing its role as the ultimate gatekeeper of the future Internet. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly.